In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how the hype about electric vehicles looks like it's finally turning into a reality. And in the second story of the day, I'll talk about a new report that CRISIL and Amphi have recently released that talks about the mutual fund industry in India. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is very easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 17th of March. See, I'm sure all of y'all are very well aware of the fact that people have been talking a lot about electric vehicles for many years now. But the thing is, it finally now looks like all of this excitement is actually turning into reality. Now these days, discussions about Teslas, Tata Nexons and electric scooters are everywhere, but there is this one segment that rarely appears in all of these conversations. Now these are commercial vehicles, especially buses and trucks. Now this is quite surprising, at least to all of us in the team, because buses and trucks represent a very tiny fraction of the total vehicles that you see on the road, but still they are responsible for a large chunk of carbon dioxide emissions from road transport. And although they make up less than 8% of the vehicles if you exclude 2 and 3-wheelers, they account for over 35% of direct CO2 emissions in the environment. And if you want to really cut down emissions in a big way, we absolutely cannot leave buses and trucks out of the electrification story. And that brings us to electric buses, which are also called e-buses. Now, this is a segment that is especially important, not just because buses have a major impact on pollution levels, but also because there is a very strong push from the government in order to introduce more electric buses across the entire country. But a downside to this is that at the exact same time, e-buses are facing many unique hurdles, from financial constraints to operational challenges in our country. But before we get into the detail here and look at India's situation as a whole, what we'll need to see is how buses fare around the globe. See, out of all commercial vehicles, buses are found it relatively easier to go electric. And the reason for this is that in most places, buses run on predetermined routes and they follow predictable schedules. And this very predictability makes it simpler to figure out how and when they will be charged. One more reason is that unlike many types of trucks, buses are often run or funded by the government itself. And this of course allows for bigger and longer term investments in charging infrastructure, especially when public money is involved in it. And the result in this is that in certain regions, bus electrification has raced quite ahead, with some countries in Europe such as Belgium, Norway and Switzerland having already replaced more than half of their entire bus fleet with electric models. Now, China is also a massive part of the story, and obviously unsurprisingly so. They got an early start here, so for a while they were practically synonymous with electric bus adoption. So much so that around 2020, China was responsible for around 90% of the world's electric bus sales. But by 2023, their share came down to roughly 60%. And mind you, this did not just happen because other countries suddenly zoomed past ahead. Rather, what happened is that the Chinese government started to scale back its subsidies once it had built a huge electric bus fleet, and this lowered China's domestic demand as a result. And at the very same time, Chinese companies like BYD and Yutong still had large manufacturing capacities, so then they began exporting more e-buses to other places, notably in Latin America, where they held an 85% market share, and in Europe, where they own about 30% of that market. But if you come closer to home in India, the situation here is a little bit different. See, our country does not really rely too much on imports for our electric buses, partly because we have a strong homegrown manufacturing base. According to credit research agency CareEdge, there are 5 major companies in India: Tata Motors, Electra, JBM, PMI and Switch Mobility, that together account for 88% of the Indian electric bus market. Now, these companies have the capacity to produce about 40,500 e-buses every single year, even though around 11,000 e-buses currently run on Indian roads only. But that said and done, this particular 11,000 e-bus number is rising. In 2024 alone, e-bus sales rose by 81% and reached 3,516 units. And by 2027 financial year, CareEdge is projecting that the annual sales could surpass 17,000 e-buses and make up around 15,000 of all new buses sold in the country. Now that is quite a big of a jump, and it tells us that the country is steadily moving forward towards electrification. So clearly for us in India, India, making the bus is not really the challenge. So the question then is, why have we not seen more and more e-buses on the road already? See, one of the biggest reasons here is that bus demand in India mostly comes from state transport undertakings, which are also known as STUs. And these particular STUs, for your knowledge, have the history of weak finances. Now, these are usually expected to provide affordable public transport services, which often conflict with the aim of staying profitable in the first place. And this entire challenge becomes even bigger when you start looking at the upfront cost of owning an electric bus. See, even though the total cost of owning and operating an e-bus over its lifetime is lower than that of a diesel bus, the problem is that an electric bus can cost 30 to 70% more to buy initially. So for an STU that does not really have too much money to spare at once, spending that big an amount all at once can be a very big barrier, even if it will actually save money in the long run. So realizing that these STUs need help, the government has now come up with several measures. Since financial year 2015, India's government has committed more than 28,200 crore rupees in a range of schemes to support electric bus adoption. Programs like the FAME 1, FAME 2, PM E-Bus Seva and PM Electric Drive Revolution in Innovative Vehicle Enhancement, which is also shortened as E-Drive, all aim to bring costs down and make e-buses more and more affordable in our country. But the thing is, subsidies alone only solve a very small part of the problem because they don't really remove the worry that STUs have about large upfront payment costs like I just mentioned. So in order to handle exactly this problem, the Indian government has introduced something known as the Gross Cost Contract or the GCC model. Now, under this particular model, STUs don't really have to buy buses. Instead, they can lease them from private operators or directly from the original equipment manufacturers or OEMs, and they can pay for each kilometer that the bus travels for. And if you're wondering, maintenance and operational responsibilities all stay with the leasing company, which removes a lot of the financial burdens from the STUs. But the thing is, even with all of this, some private operators felt uneasy because they were not sure if STUs would always pay them on time. So in order to fix this problem now, the government set up a payment security mechanism or PSM, which makes sure that if an STU does not pay on schedule, the OEM or the operator can request payment from a government-backed company called Convergence Energy Services Limited or CESL. CESL then collects all the money that is owed from the STU later, and if the STU still does not end up paying, CESL can involve the RBI to deduct that particular amount straight from the state government's account. Now, this setup gives operators greater confidence because, of course, they will know that they will be paid for their services in one way or the other. And all of this means that the government is playing a very big role now in speeding up the adoption of electric buses. Like I said, it's not just about the market buying these buses on its own. Active policy moves are encouraging companies to build more and more electric buses, and they are helping financially challenged STUs to adopt them without really having to spend a fortune upfront. With that, let's move on to the second story of the day and talk about a new report from CRISIL and Amphi that shows us how India's mutual fund industry has changed dramatically over the past several years. Now, I know this might for once sound like a topic only brokers or people who work in finance will be interested in, but the thing is, the findings actually tell us something about the entire country's changing attitude towards investing, and for all of us who are involved in this space, it is very interesting to know. Now see, more Indians are discovering that putting money into the stock market, particularly through mutual funds, can help them build long-term wealth. And that is the heart of the story here. What we are witnessing is a bit of a cultural shift in how our country overall thinks about saving and investment as a topic. People are getting more and more serious about creating wealth, staying invested in the long run, and also diversifying their savings beyond just fixed deposits or gold. But before we get into the exact numbers and talk about the details of what's exactly happening, what's important for us to note is that most of the data in this report that I'll be talking about covers up to March 2024. Now, at that time, what you need to know is that India's markets were more in a buoyant phase. Many investors were in an optimistic mood, and a lot of new money was flowing into our country and our markets. But since then, we have seen the mood turn quite cautious, with markets growing pessimistic quite a bit. But still, while these numbers might look a little bit different in the most recent months, the core message of the report still remains, which is the Indian mutual fund industry has grown massively, and it has done so in a way that suggests we are maturing as an investing population. See, this growth is pretty striking when you look at how much money mutual funds actually manage. In 2024, that total was at around 53.4 lakh crore rupees, which is about 9 times the size that it was in 2008 when it was only about 5.89 lakh crore rupees. But beyond this absolute jump in these figures, it is also very eye-opening to see mutual funds becoming such a key part of the wider economy. In financial year 2024, the investments flowing into mutual funds were equal to about 18.2% of our GDP, which is the highest on record. To explain into very simple words for you, for every 100 rupees worth of goods and services produced in our country, more than 18 rupees found its way to mutual funds. Another major change here is the growing popularity of equity funds within mutual funds. See, until a few years ago, equity funds did not really hold such a large share of the total money under management. In 2019, they made up about 30% of the industry's assets, and by 2024, that number had jumped to about 44%. Now, part of this happened after the COVID-19 pandemic when people became more open to investing in the stock market, possibly because they were at home reading a lot more about personal finance than they would do otherwise, or maybe because there was a lot of talk about market recoveries in general. But now that the market is going through a downturn to some extent, some of that enthusiasm may actually be put to some good test. But still, the long-term trend does suggest that India is growing comfortable with the idea of putting their savings into stocks via mutual funds. And it's not just the total sums that are growing here. The range of who is investing is also widening quite a bit. One very key finding here is that retail investors, which is basically everyday individuals like you and me, have a bigger stake in mutual funds than they ever did before. From 2019 to 2024, the share of retail investors in total AUM or assets under management rose from 19.8% to 27.9%. At the very same time, the number of unique investors more than doubled at this point in time. And this is quite a big jump, and it reflects what many brokers and investment platforms have been noticing, which is a surge of new participants in the market. Many of them are young or from smaller towns of India. Now see, traditionally, a large chunk of the investing audience in India came from our biggest cities, the top 30 cities in our country to be more specific. Now this is still true, but the report that we're talking about shows that the growing amount of money now comes from places beyond these specific hubs. Now it even extends to places outside the top 100 cities. And this expansion into smaller towns and cities means that the broader public is getting a chance to now understand and benefit from the financial markets. One more sign of local participation is the fact that Indian mutual funds have been quietly increasing their ownership in Indian companies. Now, over the past few years, as foreign investors have reduced their shares in some places, domestic mutual funds have actually stepped in, which reflects greater faith from local investors. There has also been a big noticeable rise in investments by women. According to this report, women's assets in mutual funds grew from 4.59 lakh crore rupees in March 2019 to about 11.25 lakh crore rupees in March 2024. And this means women are now responsible for roughly 1/3 of all the money that individual investors hold in mutual funds. Also, interestingly, women make up about 1/4 of the total number of individual investors, so they tend to invest larger amounts on average than men do. And this difference in the average investment size has become even more pronounced over the last 5 years because typical woman investor portfolio size has grown by 23% compared to only 5% for men. But if you put everything together, Indian investors as a whole seem to be acting a little more disciplined than before. One of the clearest signals of this is the surge in SIPs or systematic investment plans, which basically allow people to invest fixed amounts regularly instead of putting in large sums of money at once. Now, SIP assets have gone from 2.66 lakh crore rupees in March 2019 to 10.62 lakh crore rupees by March 2024, which basically is a four-fold jump. Now, monthly SIP contributions have also risen from about 3,100 crore rupees in 2016 to 19,270 crore rupees in March 2024, and they continued to sharply rise in the years after COVID as well. What is even more interesting beyond all of this is that when the markets dropped sharply, as they did in March 2020, a lot of investors did not stop their SIPs. And this is very different from earlier times like in March 2008, when a 9.3% fall in the market led to a 10.3% decline in net inflows for equity funds. In March 2020, though, by contrast, the market fell by 23%, yet inflows into equity funds actually went up by 8.6%. And this suggests that people now see market dips as more of a chance to invest rather than a reason to run away from it. One more trend that shows how India is aligning more with the global markets is the growth of passive investing. See, these are funds like index funds and ETFs that don't really rely on a fund manager in order to pick stocks, but they simply track a market index. Now, the total money in passive funds has grown six-fold between 2019 and 2024 at an impressive annual growth rate of 44%. Now, 5 years ago, for every 17 rupees that went into mutual funds, only 1 rupee would land into passive funds. But now it's actually closer to 1 out of every 6 rupees. And that is quite a bit of a rise. Now, much of this money goes into index funds. And in fact, the amount invested in index funds through SIPs has grown 29 times over the last 5 years. High net worth individuals or HNIs have driven a lot of this surge because they've invested 56 times more money in passive funds than they did in 2019. They seem particularly fond of ETFs, which is likely because they offer a low-cost, diversified way to get exposure into the market. So all of these numbers and stats put together paint a very interesting picture of the Indian investing culture that has changed quite significantly, especially since the pandemic. Now, of course, some people do worry that this might be leading to bubbles or excessive speculation, which is definitely always a risk when many new participants enter the market during a short period of time. But the data also suggests that many Indians are now behaving responsibly, which is a great sign for the markets. Like I said, they're using methods like SIPs, they're sticking to their plans during market drops, they're exploring passive strategies, and are generally taking a long-term view over wealth creation. That brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India's retail inflation fell to a 7-month low of 3.61% in February, driven by a sharp decline in food inflation to 3.75% from 6% in January. Vegetable prices dropped 1.07%, pulses 0.35%, and eggs 3.01%, while edible oils surged 16.36% and fruits rose 14.82%. Rural inflation declined to 3.79% from 4.59%, and urban inflation eased to 3.32% from 3.87%. Second, India's sugar production for 2024-2025 is now projected at 26.4 million tons, down from the earlier estimate of 27.2 million tons due to lower recovery in UP and reduced output in Maharashtra. But that said, with a high opening stock of 8 million tons and a closing stock of 5.4 million tons, no supply shortage is expected. Third, and the final one for the day, India and Mauritius have elevated their partnership with 8 agreements strengthening trade, maritime security, and financial collaboration. This deal includes cross-border transactions in national currencies, which reduces reliance on the US dollar, and maritime data sharing to enhance regional security. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.